Hello and welcome back to Investor Info. If the prospect of investing in the stock market makes you nervous, you're certainly not alone. Individuals with little experience in stock investing are either terrified by horror stories about the average investor losing half of their portfolio value, for example, in the two bear markets that have already occurred this millennium, or they've been duped by quote-unquote hot tips that promise huge rewards but rarely pay off. It's no surprise, therefore, that the investing emotion pendulum is considered to swing between fear and greed. In today's video, we'll be diving into how the stock market works. But before we dive into that, make sure that you hit that subscribe button and click on the bell icon so you'll get notified every time we upload a new video. Let's get started. So, the truth is that investing in the stock market is risky. But when done correctly, it is by far one of the most effective methods to increase one's net worth. While the value of one's property normally accounts for the bulk of an average person's net worth, the majority of the wealthy and extremely wealthy have the majority of their money invested in stocks. To comprehend the mechanics of the stock market, let's start with a definition of a stock and its many varieties. So let's answer this question first. What is a stock market? The word stock market is frequently used to refer to one of the major stock market indexes, such as the Dow Jones Industrial Average or the S&P 500. When you buy stock in a public corporation, you are buying a little portion of that firm. Because it's difficult to keep track of every single firm, the Dow and S&P indexes comprise a subset of the stock market, and their performance is seen as indicative of the whole market. Typically, you'll buy stocks online through the stock market, which anybody with a brokerage account, robo-advisor, or employee retirement plan may access. You don't have to be a quote-unquote investor to invest in the stock market. In most cases, anybody may do so. The Securities and Exchange Commission, or the SEC, regulates the stock market. The SEC's objective is to, quote, protect investors, ensure fair, orderly, and efficient markets, and enable capital formation, unquote. The Securities and Exchange Commission started a public service campaign in June 2021 to encourage new investors, particularly from historically underrepresented communities, to use the stock market to develop long-term wealth. You may read a news headline stating that the stock market has moved down, or that the stock market has ended higher or lower for the day. Most of the time, this indicates that stock market indexes have moved up or down, implying that the stocks in the index have gained or lost value as a whole. Investors that purchase and sell stocks seek to profit from the fluctuation in stock prices. So now let's talk about why companies issue shares. Today's corporate behemoth was most likely founded as a modest private firm by a visionary entrepreneur a few decades ago. Consider Jack Ma, who founded Alibaba in 1999 from his residence in Hangzhou, China, or Mark Zuckerberg, who founded the first version of Facebook, now Meta, from his Harvard University dorm room in 2004. Within a few decades, technology behemoths like these have risen to the ranks of the world's most powerful corporations. Growing at such a breakneck rate, however, needs access to a vast quantity of the finance. To get from an idea in an entrepreneur's head to an actual firm, they must, among other things, lease an office or factory, engage people, purchase equipment and raw materials, and establish a sales and distribution network. Depending on the size and breadth of the firm beginning, these resources necessitate substantial money. A startup can obtain these funds by either selling shares, which is equity financing, or by borrowing money, which is debt financing. Debt financing can be difficult for a startup because it may have few assets to pledge as collateral for a loan, especially in sectors such as technology or biotechnology, where a firm may have few tangible assets. Plus, the interest on the loan would impose a financial burden in the early days when the company may have no revenues or earnings. As a result, equity financing is the favored option for the majority of businesses in need of money. To get the firm off the ground, the entrepreneur may use personal money as well as friends and family. As the company grows and the need for financing grows, the entrepreneur may turn to angel investors and venture capital companies. When a company is established, it may require access to far bigger sums of cash than can be obtained through continuous activities or a regular bank loan. It can do so by selling shares to the general public in an initial public offering or an IPO. This converts the company's status from a private corporation whose shares are owned by a few shareholders to a publicly traded company whose shares will be held by a large number of members of the general public. The IPO also allows early investors in the firm to pay out a portion of their ownership, typically earning extremely large gains in the process. When a company's shares are listed on a stock market and trading begins, the price of these shares varies as investors and traders evaluate and reassess their inherent worth. There are several ratios and indicators that may be used to evaluate companies, and the most prominent of which is arguably the price to earnings or PE ratio. Stock analysis is further divided into two categories: fundamental analysis and technical analysis. So now let's jump to the next question of this video. How does the stock market work? The basic idea underlying how the stock market operates is actually very straightforward. Buyers and sellers can negotiate pricing and conduct deals on the stock market. The stock market operates through a network of exchanges, such as the New York Stock Exchange and the NASDAQ. A company's stock is listed on an exchange through a procedure known as an initial public offering, or again, an IPO. Investors buy such shares, allowing the company to acquire funds to expand its operations. Investors can then purchase and sell these stocks among themselves, while the exchange monitors supply and demand for each listed stock. This supply and demand influence the price of each asset, or the levels at which stock market players, such as investors and traders, are ready to purchase and sell. Buyers give a bid, or the most they're ready to pay, which is generally less than the amount sellers ask for in exchange. This discrepancy is referred to as the bid-ask spread. A trade can take place if a buyer raises their price or if a seller lowers their price. All of this may appear difficult, but computer algorithms often do the majority of price-setting computations. When purchasing a stock, you'll see the bid, ask, and bid-ask spread on your broker's website, but in many situations, the difference will be pennies, which will be of little importance to both novice and long-term investors. Historically, stock trades were most frequently conducted in a physical marketplace. The stock market now operates electronically, using the internet and online stockbrokers. Each deal is conducted on a stock-by-stock basis, yet overall stock prices frequently move in lockstep as a result of the news, political events, economic data, and other reasons. The next question we'll be answering is, what is stock market volatility? Again, investing in the stock market is risky, but with the appropriate investment strategy, it can be done securely and with little chance of long-term losses. Day trading, which is buying and selling stocks quickly depending on market fluctuations, is very dangerous. Long-term stock market investment, on the other hand, has shown to be a great strategy to accumulate wealth over time. Before adjusting for inflation, the S&P 500 has a historical average yearly total return of around 10%. However, the market seldom provides that return on a year-to-year basis. Some years, the stock market may finish up much lower, while others may end up significantly higher. These huge movements are caused by market volatility, or periods when stock values abruptly surge and fall. If you're buying and selling stocks, there is a considerable possibility you'll make a mistake and purchase or sell at the incorrect moment, resulting in a loss. The key to investing securely is to remain involved, through the ups and downs, in low-cost index funds that monitor the whole market so that your returns can approximate the historical average. So let's wrap all this up by talking about how to invest in the stock market. You may already be investing in the stock market if you have a 401k via your employer. Mutual funds, which are frequently made up of stocks from a variety of firms, are prevalent in 401ks. Individual stocks can be purchased via a brokerage account or an individual retirement account, such as an IRA. Both types of accounts may be formed with an internet broker where you can purchase and sell investments. The broker operates as a go-between for you and the stock exchanges. There are dangers associated with every investment. However, stocks entail a higher level of risk, as well as a higher potential for gain than other types of investments. While the market's track record of increases implies that a well-diversified stock portfolio will improve in value over time, stocks can also undergo sharp drops. You may develop a diverse portfolio without acquiring many individual stocks by investing in an index fund or an exchange-traded fund, both of which are types of mutual funds. These funds seek to passively replicate an index's performance by owning all of the equities or assets in that index. Index funds and ETFs, for example, allow you to invest in both the Dow Jones and the S&P 500, as well as other market indices. Stocks and stock mutual funds are good for long-term investments such as retirement, but are inappropriate for short-term investments, which are generally defined as money you need for an expense within 5 years. With a short-term investment and a strict deadline, there's a bigger possibility you'll need the money back before the market has recovered losses. And there you have it, folks. Now that we've discussed how the stock market works, let us know in the comment section down below how you plan to use this knowledge to enhance your portfolio. Remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video.